I want to thank the National Economics Club for inviting me here to speak at your annual dinner. Thank Arent for the kind words. I probably will let you down because though I got a Bachelor of Science of Economics, I think that's what Wharton said it. I was kind of a numbers and finance guy, and I didn't, economics is probably your field. And I went off to Goldman Sachs for 18 years, and so I'm sort of a washed-up old banker, and not quite good. I don't think I'm going to give you the word on how quantitative easing is going to work, and I see my friends from the press back there, and I don't think I really want a story about me swimming outside my lane. But when the president-elect asked me to take on this job, and the lane I swim in is derivatives. So that's what I'm really going to speak on tonight. As you all know, the Dodd-Frank Act, which was passed in July, has many features to it, but one of the things is that it brings comprehensive regulation to the over-the-counter derivatives marketplace, or if I can call it, the swaps marketplace. Before I go on, I'm just going to say a thank you. I do this in all my speeches now, but a thank you to my fellow commissioners and the staff. The CFTC is only about 680 or so folks, but right now we are taking on the task of writing rules as Congress has dictated in a variety of areas, and I'll discuss some of them. But it is a very challenging job. Tomorrow we have a meeting, as we're doing almost bi-weekly now, and we're going to consider, I think it's 7 separate rules tomorrow. Uh-oh, I just made news. But so I wanted to start with that. Thank you. Derivatives, of course, have been around a long time. I was asked at the table, when did it start being called derivatives? But in the Civil War, in 1865, before Lee surrendered, in Chicago, there were some derivatives being traded. This is true. There was, it was about a month before he surrendered. There were some derivatives being traded in Chicago, and they were for grain merchants and farmers to hedge corn and wheat, and then soy was quickly behind that. And it was a great innovation. People knew how to sell grain products forward. That means when you had an intent to deliver. So a bunch of business economists, I can say this. That's when you had an intent to deliver. And somebody came up with an innovation. It's called a futures contract, where you could financially settle the contract. You wouldn't necessarily have to deliver the product. So they've been around since the 1860s. There wasn't regulation until the 1920s. And federal regulation came to this futures market, and it was augmented in 1936 through the Commodities and Exchange Act, and that set up our predecessor actually in the Agriculture Department. And it was largely around these derivatives, but we called them futures. And what that regulation did was comprehensive. It said that futures must be traded on a regulated exchange, 100% of them. Somebody asked me about onions. Onions were banned. Onion derivatives or onion futures were banned in the late 1950s because a young congressman from Michigan, Jerry Ford, worked on that. But things sort of stayed the same until the 1970s. There started to be oil and metals futures, derivatives again, and starting to be financial derivatives. But they were all 100% on exchange. Our predecessor came out of the Department of Agriculture in 1975 and regulated the whole marketplace. And then in 1981, Salomon Brothers, which is now part of Citibank, but Salomon Brothers brokered a transaction between the World Bank and IBM. One of them could borrow cheaply in Japan, and one could borrow cheaply, I think, in Switzerland, if I remember the story. And they brokered this thing between them, and that was called a currency swap. And that's when the swap market started to take off. That marketplace was not regulated, and it still really isn't regulated in Europe, Asia, or the US. It was not cleared through clearinghouses. They were just done bilaterally between parties. At first they were brokered, but quickly they were taken onto the balance sheets. Well, that unregulated swaps market was at the center of the 2008 crisis. It's not the cause, it's not the only piece of it, but it was certainly at the center of the crisis. There are many macroeconomic pieces that you all know more about than I do. And there was also many breakdowns in financial regulation, which I think failed the American public, but it was also breakdowns in the financial markets themselves. But this was part of it. AIG and the $180 billion, certainly. Each of you, by the way, put up $600 for AIG. I don't know if you've ever thought of it that way. I have 3 daughters. I would like to have my $2,400 back. But we did, every taxpayer. If some of you aren't American citizens, maybe not in that. In bringing oversight to the swaps market, Congress really just built upon the regulation of the derivatives marketplace that existed, the futures marketplace. The Dodd-Frank Act brings new reforms to this marketplace to achieve 2 goals: increased transparency and lower risk. So I'm going to take a little time to talk about each of those and then hopefully take questions. And hopefully not about quantitative easing or the economy. Economists and policymakers, I think, and I suspect many of you here, would agree and recognize that market transparency benefits the public and probably has for decades. It also, of course, benefits regulators as well. Increased transparency in the swap markets benefits regulators, and the Dodd-Frank Act establishes that all swaps entered into with U.S. counterparties, whether they're to end users, whether they're between a big swap dealer and a corporation, or whether they're done on a exchange, all of them have to be reported into something called a swap data repository. And this information has to be available not only to the regulator, like the CFTC, but the other federal regulators. So the bank regulators will be able to see into the data, into a data repository. And also that we enter into information sharing arrangements with international regulators. And data repositories will not be open to the public, but they'll be open to the regulators, transaction information, and position information. We anticipate writing rules around these swap data repositories to perform the core function. Basically the core function of collecting data, maintaining that data, and allowing us, actually we got in statute that we can tie into it directly and electronically. We anticipate rules governing how the data must be maintained. Hopefully somewhere in the next few weeks we'll publish the proposed rules on that data, but that data will be pretty extensive so that the data repositories will have the transactions, and this will help us police the markets for fraud, manipulation, and other potential abuses. Congress didn't believe, and I know we didn't believe, that that was enough, though, that it wasn't enough just to have information shared with regulators, but it's really public market transparency that helps the overall economy. The more transparent a marketplace is, the more liquid it is, the more competitive it is, the lower the cost, whether you're an investor, you're a hedger, or ultimately the customers behind those people who are hedging. We all know about transparency in the securities marketplace. Transparency in the securities marketplace, if you want to buy 100 shares of stock, you know where the last 100 shares of that stock traded. But it's also transparency in the securities markets help issuers, corporations, lower their borrowing costs, because when you can see in a transparent marketplace and you can price your capital, off of that transparent marketplace, that helps you. In the futures marketplace, that which we regulate, hedgers and speculators alike can see where futures trade. You can see where the last trade in the futures marketplace occurs. This is not currently the case in the swaps marketplace. And though there are many market providers that provide some liquidity into that marketplace, it's not liquidity into each transaction after the trade or even before the trade. So the Dodd-Frank bill brings 2 types of transparency: after the trade and before the trade. We call that in our sort of line of work pre-trade transparency and post-trade transparency. And with regard to this type of transparency, the important thing is that everybody gets to see it. So on the pre-trade transparency, this occurs on a marketplace. Just like when you want to go buy 100 shares of stock, you can see the bid and the offer of the stock. That's what's called pre-trade transparency. The bill actually says that the trading facilities themselves have to provide market participants with impartial access. That means anybody that wants to have access to a trading facility who meets the membership of that trading facility has to be allowed in. Congress was also very specific as to how to benefit after the transactions occur, or what's called post-trade transparency. And they were very specific. Congress said that this transparency has to happen as soon as technologically practicable. So it's not like next month, it's not like tomorrow, it's really in a real-time basis. And the words real-time reporting was used in statute. Now there is some exceptions. If it's a large block, we're supposed to do a rule on how many minutes or how long it should be delayed. In the futures marketplace currently, it's a 5-minute delay for blocks. We haven't figured it out. We'll have to sort through and get a lot of public comment. But on most transactions, which are not large enough to be a block, it's as soon as technologically practicable. Both transparencies after the trade and before the trade help economic activity, lower the cost of hedgers, help issuers in the marketplace. The other main part of the bill is lowering risk. And transparency itself helps lower risk in marketplaces. So that's the first fundamental way to lower risk. But in addition, there are 3 other ways I would highlight in all the details. One is what's called mandatory clearing, and I'll come back to that. 2 is the actual regulation of the dealers in the marketplace for their business conduct and the supervision of their business. And 3 is regulating those same dealers for capital and margin. So let me say a few words about each. On clearing, clearing is not a new innovation. In fact, it was an innovation of the 1890s. So remember back, derivatives started in the 1860s, right before Lee surrendered. But by the 1890s, the paperwork and the back office of this newly formed thing in Chicago was a bit of a mess. And people figured out that there could be a central counterparty called a clearinghouse that functioned between the buyers and sellers of risk, between usually the grain elevator operators and the farmers, and could stand between them if one of them defaulted. Clearinghouses have functioned both in clear skies and during stormy times, through the Great Depression, numerous bank failures, a couple of world wars, and even the 2008 financial crisis. And I would note at the same time, with great regularity, every 3 to 5 years, we have major banks fail. Clearinghouses are not without risk. They need to be well regulated because, in fact, they concentrate risk. But they're well regulated in many ways to make sure that they're in fact, if you take the 120-year run, we don't have any major clearinghouse in this country having failed. Currently, swaps are not part of this. So what we call the futures marketplace, it came in 120 years ago, but this swaps marketplace did not. And they're often economically equivalent contracts. Swaps stay on the books of the dealers. If we take a look at AIG, when they had swaps, they stayed on the books of the dealers, and when we all put our $600 up, that included you, Ed, you got when we all put our $600 up, that was partly so AIG could pay its counterparties to its swap transactions, and that got quite a bit of publicity and so forth. These dealers, these swap dealers, are often thought of as too big to fail, but in fact they're too interconnected to fail. This interconnectedness heightens the risk that a dealer's failure will reverberate through the financial system. And unclear derivatives allow the failure of one institution to potentially cascade, just like dominoes, through the system and throughout the financial system in particular, until it comes crashing down on the public. The Dodd-Frank Act's clearing requirement then is then mandated for the swaps marketplace. Now, it's not 100% of the swaps marketplace. It's that which is standardized enough to be brought into clearinghouses. And the clearinghouses will require that each of the counterparties post collateral. That's the key function. They mark to market. Every single day you have to value the positions, and every day post collateral. Roughly 90% of the marketplace is between financial entities, the swaps marketplace, whether it's a leasing company, a hedge fund, insurance company, or a bank. And about 10% of the marketplace, 9 or 10% of the marketplace is non-financial companies, commercial entities, if I might. The Dodd-Frank Act actually makes a distinction between these two because it says all financial entity transactions between a swap dealer and a financial has to come into the clearing house. This exception for clearing for commercial end users was an appropriate balance that Congress sorted through. In essence, the transactions between non-financial entities and financial entities are out of clearing, but everybody else is in. And why is that, in a sense? Well, of course, one reason is Congress ultimately had to sort through and make a compromise of competing interest. But I think it's an appropriate compromise in that the transactions between non-financial entities and financial entities don't pose the same risk in the midst of a crisis. In the key risk in the middle of a crisis is that it spreads throughout the financial system. And it's the financial system that's connected one financial firm to another financial firm, the run on the bank that sort of cascades through the financial system. Two other ways that Congress addressed lowering risk, and they're both in regulating swap dealers. One is through capital and margin. The Act is very specific. It's specific in that it says that the Federal Reserve and the bank regulators will set capital margin for the bank swap dealers, and then I guess if you're not a bank, you get the SEC or the CFTC to set your capital margin. And it says it's to offset the greater risk to the swap dealer and the financial system from the use of swaps that are not cleared. So the main focus on this part of the statute is on the non-cleared swaps, those that are staying on the dealer's books. Move most of it to the clearinghouse. Everything else gets lowered risk through capital and margin. The other part of lowering risk was also making sure that there's business conduct standards and documentation. Business conduct standards is really managing the risk of a business and the diligent supervision of that risk. One of the rules actually we're taking up tomorrow is risk management rules that we'll propose in the midst of what we're doing tomorrow. But it's also the back office function, or what's called the timely and accurate confirmation, processing, netting, documentation, valuation of swaps. I just read from the statute. But these sort of back office functions of the documentation have, in times of crisis, caused greater risk than you can ever imagine. There's a third area, which is establishing firewalls between the trading area of the firms, the research area, and the clearing activities. That's another one of the proposed rules we're going to, I think, do tomorrow. We'll take up and consider tomorrow. But in all three of these areas of business conduct standards, they're kind of, in a sense, the back office. They don't get a lot of publicity, but I think Congress and we both hope that it's a help to lower risk. Let me just say something on implementation and then take questions. We're given 360 days to do all this. It was signed July of this year, so July 15th of next year we're supposed to be done, and anyone's counting, that's 249 days to go. We are hopeful, though we're human, so we'll fall short here. We're hopeful to get our proposals out through next month, before Christmas. But I do stress we're human. We'll have 3 or 4 of these slip, and my friends in the media will say, aha, something slipped. But we find it usually takes four to 6 months from the time we put out a proposed rule to finish it up, and we're trying to finish it all up by next July. If we get these things out in January, then it just shortens the time frame that we have to try to finish them up. There's just two key principles that are really guiding us. Principle one is follow the law. The law is very detailed. Of course, there are going to be many market participants that will advocate their positions to us, but the law is very specific. It requires for that real-time reporting I talked about. It requires for some pre-trade transparency. It requires the clearing of standardized swaps and so forth. And the second thing is to consult heavily with the public and other regulators. We actually list on our website all of our public meetings. I guess, Scott, we're going to list this tonight. And so not everybody's got to sign in, but on smaller groups, we literally list who's there and the questions and what we address in those meetings. And I think we're up to 350 meetings that are listed already in the last, I guess it's been 111 days since the President signed the bill. So you can do the math, and that's including weekends. That would be 3 meetings a day. They're not all with me. We've also working very closely with the SEC, but all other federal regulators. I think we're probably over 200 meetings with other federal regulators, and with the international regulatory community, most closely with the European Commission. And they put out a proposal about 6 weeks ago that's very similar to what we're doing. Japan actually moved first in May. They passed a derivatives legislation that on the clearing side at least is very close to ours. But that's our public consultation for now. But importantly, once we put out rules, we want everybody to comment. We're usually leaving these out for 60 days and asking for comments. But our goal, of course, in this whole process is to try to do what Congress asked us to do, lower regulatory uncertainty in a sense, and finish up the job by next July. But again, I'm sure something will slip, and I can't even predict which it is. So with that, I thought I would take questions in any way that, Alan, Eric, you all want me to do it.
Questions open the floor. I have a couple questions I can start with, if that's fine.
Sure.
I was curious as to you can discuss a little.
Dana, I bored you that much, huh? That basically means I did my job.
I was wondering if you could discuss your relationship more with the SEC and also your anticipated relationship with some of the developing regulators as well, like the Consumer Bureau as well, the Consumer Financial Protection Bureau, and also the OFR as well, the Financial Research Office.
So the question is our relationship with the SEC and other regulators. We've been working very collaboratively with the Securities and Exchange Commission. President Roosevelt went to Congress in the 1930s, and there's this great speech that he asked for 2 regulators to look at regulating the securities markets and the commodities markets. And since Congress responded and set up our predecessor in the Agriculture Department, and of course we all know the Securities and Exchange Commission, we've had 2 market regulators in this country, whereas it's quite common in most countries to have 1 market regulator. But it was President Roosevelt in the 1930s Congress. And so it's incumbent upon us to work very closely in the derivatives field as well as other fields. They will have part of this over-the-counter derivatives marketplace, that related to narrow-based securities, indices, and single stock credit default swaps and the like. It's called securities-based swaps, technically, in the bill. We laid out a program with Mary Shapiro and her folks for rule writing. All of our proposals through middle of December, all of theirs through the middle of December, will both slip a little, but we actually have lined it up to do it on the same time frame. Probably 3/4 of the meetings we're having with U.S. regulators or with the SEC. And that's an estimate. Maybe it's 2/3. And a number of rules are joint, meaning it takes 10 commissioners, not 5. And those joint rules, just because of the human element, take more time. And a couple of those are about product definitions and entity definitions. What is a swap dealer? What is a swap? Things like that. And we're hopeful to get those out. They won't be tomorrow's meeting, but we're hopeful to get those out in the next several weeks. With other federal regulators, we're working very actively, mostly with the Federal Reserve. They're very helpful, terrifically helpful on clearing, swap data repository, rules about swap dealers, and the New York Fed. The two agencies you mentioned that are new agencies, the Consumer Bureau and the Office of Financial Research, haven't really been stood up yet. But we have spent some time with Treasury, particularly around swap data repositories, to ensure that what we're thinking about on swap data repositories don't overlap too much with what they're thinking on this new Office of Financial Research. There's going to be an Office of Financial Research housed in Treasury that will be making data available from the whole financial market to the regulators, but we're trying to make sure that we don't have sort of overlap there too much. I hope that answered your question.
Also, this is the Consumer Bureau as well?
The Consumer Bureau, though I have a seat on the new Financial Stability Oversight Council, there really has been, that's largely amongst the bank regulators, and it's not something. There may be a meeting or two at staff level, but I'm not aware of meetings that have occurred related directly to our rules yet, because of course they're trying to first stand up that agency over the course of the next year. So.
I've always been curious for a long time whether in a highly leveraged market, whether the so-called market makers are efficient enough that if some really gigantic hit on the market takes place, they could prevent a lot of people from going under. So like a lot of hedge fund managers have stop losses. As long as there's market makers, the market's starting to crash, they're out, they lose their equity, but at least they don't pass it on. And recently we've had these computer-generated drops in the market that are quite huge and sudden. And we say, at the end of the day, we end them. But I'm curious, when those have occurred, is there some measure, some way to go in and actually figure out at certain points in time, were there a number of firms, individuals, hedge fund managers, other people who were actually underwater? And the reason I ask this is suppose there's some more gigantic real crisis. China has a revolution, or a couple countries default, and you really have a sudden drop. Do we really believe the market makers are going to be able to allow people who say are 80% leveraged or 70% leveraged to be able to get out, which as I understand the market makers do through all these stop loss functions?
And your name is?
I'm Gene Sterling.
Hey, Gene. No, I didn't mean for the press or anything, but but it was Gene that said something about no. You had a number of questions in there, but in the derivatives marketplace, whether it's the futures marketplace that's been regulated for so long or the swaps marketplace to come, there is a concept: if somebody is going to default on a position, then that position can be closed out very rapidly if it is in a clearinghouse. And that's one of those innovations from the 1890s that has actually worked so well. It does rely on liquid markets, which is part of your question about market makers. But, and you're right, there's a lot of leverage in derivatives. You only post margin to cover the feature of if you default, a margin generally is for several days. It's to take the shock in the marketplace if the clearinghouse has to unwind the position in the next several days. And so I think that will work well if you set the margin parameters, whether it's 3 days or 5 days or things like that. Your other question is about market makers and liquidity. And we have seen in the events of May 6th, certainly, May 6th was when the overall markets were down about 3%, and then within the course of 13 minutes, they dropped another 6.5% to just under 10% down. And then they rapidly came back, but then in individual securities, some securities went to a penny a share, actually, in those events of May 6th. And that's something we've studied, our staffs have studied very closely. And we were able to see that market makers and liquidity dried up in the midst of that, and very much so dried up. And that's something that both the SEC and the CFTC are looking at very closely, and we have this wonderful outside panel of experts. It includes 2 Nobel laureates in economics, I should note, given that we're at an economics club meeting. But market makers market makers make individual choices every moment in the market as to whether they're going to bid or offer or stand down or step back, because providing liquidity also bears risk. So I don't know if I've answered your question or left you with some doubt. I think clearinghouses work very effectively to have enough margin to close out a position, hopefully within the next several days. When Lehman Brothers failed, the clearinghouse function worked both in swaps and in futures. Actually, remarkably well it worked.
Hi, Rick O'Sullivan, and my question, the argument in favor of nonprofit independent self-regulation is that the interconnectedness of the players makes self-regulation more effective and more quick than government oversight. So why do you think the interconnection failed here? And do you think that the Dodd-Frank Act addressed that shortfall?
If I might, I think you're connecting 2 things. I think the interconnectedness of the financial system makes it harder for your government actors to let somebody fail. I was honored to serve also in the Treasury Department in the late 90s. And I remember visiting a hedge fund called Long-Term Capital Management. And it was a weekend before Rosh Hashanah. And the secretary called me up on a Saturday and asked me to go up to New York, where I met Peter Fisher from the New York Fed. Ed will remember Peter. And we visited them on a Sunday, and then I jaunted off to the airport and called the Secretary of the Treasury, and he said, "What do you think will happen?" And I could discuss what was going to happen to the 12 or 15 largest counterparties, but it was pretty darn interconnected, long-term capital management. I should say background, they had $4 billion of capital and about a $110 billion balance sheet, but they had a $2 trillion derivatives book. And that interconnectedness, we couldn't tell what was going to happen next. We could add it up. I remember the numbers. To this day, I remember the numbers. And we thought it would fail by that Wednesday. I even told him on that phone call, I said, "Look, I'm going down. It's Rosh Hashanah. I'm going to the synagogue, atone for my sins." But, I thought it would fail by Wednesday. I think it was Bear Stearns was going to pull the line by Wednesday. But the interconnectedness was definitely what we focused on then, and I think I wasn't a government actor. I wasn't in the Treasury or the Federal Reserve in 2008, but I have no doubt that the pressures on our government actors in 2020 or 2030, when the next crisis comes, and as sure as we're here, there will be another crisis at some point in the financial system. Banks, I believe, need a freedom to fail. And one of the ways to get the freedom to fail is to make them less interconnected. And to make them less interconnected in this derivatives world would mean getting as much as possible into these clearinghouses. I think that's a very different question than self-regulatory organizations. I think self-regulatory organizations, which have been around since the Buttonwood Convention in the equity markets, I mean, like way over a century, work well where a government regulator like the CFTC or SEC has the ultimate responsibility, with the oversight of Congress, to set the regulations, but you can also rely on a self-regulatory function. We have something in our world, and of course there's one in the securities world as well.
But the question is, given the shared risk why did the organizations fail to self-police each other?
Well, I think it was I understand now the question. The question is why don't, if I can restate it, why don't market forces work for self-policing? And I think because there's, if I can remember my Wharton education, is the term externalities. I think that there's a lot of externalities. What's that?
Agency.
Agency risk, is that what it is? So I didn't do as well in economics, but I think that there were 4 or 5 assumptions embedded in why derivatives weren't regulated, some of which I was associated with, so I'm, too. This one I wasn't necessarily associated with, but I think one of the assumptions is it's only big actors. It's only big banks that are doing it, and the banks are regulated anyway. And I think we found out that wasn't so true. Look at AIG. They had this thing over on the side there. And even Lehman Brothers and others had other things, affiliates that weren't well regulated. But this assumption that just market actors were going to self-police themselves, I think falls down because any one of them might be trying to manage their risk to maximize their profits. But if they fail, they can bring down others. There's the cascading effect. In addition, I think we have a perverse outcome of the 2008 crisis. And the perverse outcome is that markets will adjust to some belief that governments will step in again. In Europe and in the US, governments stepped in with your $600 for AIG, or we could take $700 billion and divide that out and get a different figure. So I think that we have to fight against that moral hazard as well.
Yep. So my question is about derivatives and transparency and how much the two go together. And my standard for transparency is going to be that no matter how complex a derivative is carried by 2 equal and opposite counterparties. So my question is, how comfortable are you, not necessarily when it's done, but a couple years later, these things are and those 2 equal and opposite counterparties ought to be roughly equal and opposite dollars. You've got some complicated thing that Citibank sold to somebody else, Bank of America, and Bank of America says, I'm owed $100 million on this, and Citibank said, yeah, I owe you $100 million on this. How close to that are we or going to become?
Great question. Transparency will be best where they're standard or benchmark reference. Some of you will know derivatives, if it's a 1-year interest rate swap, a fixed payment versus floating, things like that. I think those will be able to trade on swap execution facilities and probably be fairly transparent. I think the non-benchmark interest rates will be less transparent, in a sense, less liquid, but still be on transparent platforms. I think the highly customized products, I learned the other day that there's something called high protein whey swaps. Does anybody in the room know what a high protein whey swap is? Not one. Well, you know what curds and whey are? That's the whey I was talking about, not spelled W-A-Y. All right, it's a very small market. It's a very small market. But there are more problematic things than high protein whey swaps. Those are not a problem. But my point of the little story is that there are very customized markets that will not trade on swap execution facilities, and there will be post-trade reporting, and the statute says explicitly that dealers in the customized area, the non-cleared area, have to share with their counterparties their mark-to-markets daily. So your question is what if one big player says it's 100 million and the other says it's 120 million?
Well, let's take that individual deal. Let's take the Huawei swap.
Well, those are $200,000 swaps.
And will you know whether the two sides of that deal are valuing it roughly equal and opposite?
So this is called something called valuation methods. We're going to do a business conduct rule on, because the statute tells us we have to, on documentation and on valuation methodologies. So I don't know what we're going to do in that rule yet. However, the goal
Yeah.
is that if there's a dispute, they have to have a dispute resolution methodology, that the two dealers, if one trades it and says it's 100 and one says it's 120, it has to be resolved in a short period of
But I'm
time.
talking about the equal and opposite sides of an existing deal 3 years later. Who's matching them?
Well, ultimately, it is the private sector. Ultimately, it is, but the regulators of the dealers, whether it's the bank regulators or us, what we're envisioning is putting in place a rule, because Congress told us to, on valuation methodologies. So that gives at least a process. We haven't written the rule yet.
Okay.
But that gives us a potential process on not only valuation methodology, but what you're focused on is if they disagree.
Yeah.
And in the trade, that's called disputes, and then you have to have a dispute methodology.
But that only gets found out if there's like a hypothecation or settlement or something. Otherwise, these guys can be carrying this at wildly different prices and nobody's going to know.
Well, it sounds like you could help us write the rule.
My name's Rabina Reed, and I'm curious about.
Hi, Rabina.
Hi. I'm curious about your oversight of financial advisors and how they go about marketing derivatives and swaps. Is that something that you have oversight of?
Well, yes, we do. We as you know, the Securities and Exchange Commission has oversight of like broker-dealers and investment advisors. We oversee something called commodity trading advisors. All right, it's in the statute, has been for decades. That's somebody who advises the public on buying or selling futures. Well, Congress inserted the word swap into that. So a commodity trading advisor will also be somebody who advises the public on buying or selling swaps or futures. They're not as many as over in the security space, where there's a lot more, measured by multiples more brokers than commodity trading advisors, but the answer to your question is yes. And so now we have to look at the current rules around these trading advisors, commodity trading advisors, and see how we change them. Secondly, there is something in the statute that we need to write is business conduct standards for sales practices, protecting the public not only against fraud and manipulation, but explicitly the statute says we have to have some provisions for what's called special entities. Special entities in statute are municipalities and pension plans. So both the SEC and we have to write something around this, what I will call sales practices to special entities. Does that?
Yeah, that's what I was curious about. I work for the Federal Transit Administration, so I was
Yeah.
curious about
It's $600 that worries me. I'd like to get it.
Wait, what worries?
$600. When the
That's-
energy pays back, I'd like to collect it, but of course I won't. And it's a gimmick to advertise how big the deal was. But of course, taxes vary among individuals. I don't pay nearly enough to warrant being paid back $600, and sometimes it's used without danger or harm, and other times it's a scare tactic to make people think that they individually owe the government $36,000, the average of something or other. That's all.
It's a fair point. I don't use it for any other reason to take a large number and to connect it to all of us individually. I mean, it's remarkable to me that an insurance company, it was just about the largest insurance company in the world, but an insurance company had this affiliate that led, I think, not just to the $180 billion to be put into it, But it was so ineffectively regulated. I mean, I think this is a failure of regulation as well, that we collectively had to put that much money up. I mean, I just believe there should be a freedom to fail, and that was so interconnected, back to this question of interconnected, that the people responsible in government did the responsible thing and said that's too great a risk, a day or two after Lehman had failed. And so they stepped into the breach, and so that's why I used the number. Alan?
Gary, recently a lot of commodities, in fact most of them, when I checked the chart yesterday, have risen in recent months. Gold, the other metals, lots of non-edibles, most food products with the exception of cheddar cheese. Maybe that's because it has high protein whey. There is, now that I understand it, but on a serious note, some of this is undoubtedly driven by higher domestic demand, which may lead to higher prices, manufacturers passing things on for goods with cotton, goods with food products, and foreign demand. But on the way down here, I heard the comment that some of the $600 billion that the Fed is pumping in is being used for commodity and other speculation. To what extent, if at all, will the new rules or the old rules prevent speculation, which drives up prices and helps potentially fuel inflation?
Well, the debate about the role of speculators in markets was probably, I don't know, but certainly it predates the last century. It probably goes back centuries. Maybe in Roman times they debated speculators in the wheat markets as well, but they certainly it was a great part of the debate in the 1920s and 1930s. Speculators have a role in the marketplace. Hedging, I'll go back to corn and wheat, but if you're planting your crop and you want to hedge your risk at harvest time, generally the person on the other side is a speculator. They're speculating on what the price of wheat will be, 4 months hence. And so the marketplace and our market structures allow speculators and hedgers in the marketplace. Part of the 1930s rule spoke to, well, might there be excessive speculation? Because speculators and hedgers are allowed in marketplaces, and that's, at that time, Congress dictated that our predecessor would set some position limits to help guard against the burdens that might come from excessive speculation. And we've done so in the agricultural space for many decades. And there's a lot of debate about that, but we've done that. So in this law, the Dodd-Frank Act, it suggests that we go forward and do those position limits for the physical commodities of finite supply. I don't know if that answers your question, but I do want to say, speculators have a role in the marketplace. What the key thing to a market regulator is to make sure the market is transparent, because transparency allows buyers and sellers to meet. And what you all know is the price discovery function to work. And to police the markets against manipulation. Congress has given us some new tools in that regard against what's called disruptive trading practices. It's broadened some of our authorities on anti-manipulation, taking on some of the features that the Securities and Exchange Commission has had as well. But it's really transparency, policing the markets, but speculators and hedgers do meet in marketplaces.
Probably have time for about maybe one or two
Here we go.
questions, I guess.
Yes, Craig Miho. I have a question for you on Treasury is currently determining whether or not to exempt foreign exchange swaps from regulation. Where are you at on that?
I think the Treasury has an advance notice of proposed rulemaking, which is a Washington speak to say they have a series of questions out, and I'm not going to make any news tonight trying to answer their advance notice of proposed rulemaking through tonight's speech. So that means I can take another question.
Stuart McIntosh, you touched sort of implicitly on one of the criticisms of the pre-reform structure in America, namely that similar products could be treated entirely differently from a regulatory standpoint by you and the SEC. How confident are you that this new reform and your part in building it will close that gap to stop unreasonable regulatory arbitrage?
I think that It does a tremendous amount, but it doesn't do everything. The tremendous amount is that for both agencies since the 1980s, there's been this unregulated gap and growing gap. In the securities world, you could do a swap on an individual security, and that wasn't regulated, but you could buy or sell the individual security, and it was. Think of the credit default swap marketplace. And in our marketplace, we regulate euro-dollar futures, and I think very successfully, and there's a lot of transparency and a lot of record, and we don't currently, until next July, regulate interest rate swaps, which is economically similar, if not equivalent, to a strip of euro-dollar futures. So I think it will close a lot, but there will still be some differences between securities regulation and futures regulation, and or even differences between securities regulation, swaps regulation, and futures regulation. So, Ed, and this will be the last one.
Gary, one of the aspects of the Dodd-Frank bill was the creation of this Financial Stability Oversight Council, which I gather is...
How are we doing?
Well, it's supposed to be looking out for new risks in the system. And I'm just wondering, based on your experience having both been in the private sector and the public sector, you talk a bit about the difficulty of what the council's going to have in trying to monitor these risks, particularly when markets tend to innovate very quickly, and then also trying to coordinate how to respond to these risks. The challenge that the council is going to have.
Well, I think that the council has some advantages over the private sector and some disadvantages in terms of information. It does have some great advantages because you've got the Federal Reserve and Treasury and the FDIC and the SEC and so forth. So you've got a lot of federal regulators that have access to aggregate data. And if we do it well, and that's still an if because it's just being stood up, then you can get the benefit of that of a collective council, that aggregate data. My time at Treasury when I was there in the 90s, whether it's this long-term capital management circumstance or even my time at the CFTC more recently, well, there's a tremendous amount of private data that we can look at. It's not like sitting on a trading desk. I mean, and I will say, when I was on Wall Street and I sat on a trading desk, you just have more of a feel, of that daily flow. When you're, in government, and whether you're up in the Congress or you're thinking about appropriations or you're overseeing markets, it's one step removed from that sort of tactical, that very tactical daily feel. But the private sector, I think, has a different approach. The private sector is, as they, I think, rightly should be, is thinking about maximizing their returns for their shareholders or their investors. Whether it's over the long run or the short run, they all have different approaches. And the government folks like us are trying to collectively, hopefully, lower risk in the system and promote economic activity, hopefully through greater transparency and certainty. There's never complete certainty, but lowering risk. So there's different roles. I think the Financial Stability Oversight Council is a good step forward. I was honored to be on something called the President's Working Group on Financial Markets, which was a collecting of some of the regulators. I think this more formalizes it, and Treasury is standing it up in a way that the early signs are. I think they're doing it. I would say just seeing it a little bit in its nascent stage in a good way. But this is something probably decades from now people will write back and say whether we, what we did. So, thank you.
Thank you.